So is that your office task, Harshan?
Yes.
Very nice.
For this campus is lovely. We love it.
Yeah.
And I shared some photographs of this campus with with our friend at Konkuk University. Sanghan, yeah. And he said that as an undergrad student, he had sketched this campus.
Oh, really?
So he shared some of the sketches of campus's design done by Louis Khan. He was a very famous architect. So
he's on the major was architect, so that makes sense.
That's right. Yeah. He was very excited.
And I look at the flyer for this webinar series and the picture of your campus. Maybe your building, and it looks beautiful.
Beautiful, yeah. It's very. There's a nice history to how this whole architectural vocabulary came into picture. So.
Very nice.
Perhaps we could start recording now, Vidhi. I think we could perhaps.
Yes, sir. It started just one.
Thank you.
Okay, should we start?
Yes, Dr. Das.
Okay. Good evening. On behalf of the Misra Center for Financial Markets and Economy, Indian Institute of Management, Ahmedabad, I welcome you all to this webinar. In particular, I welcome Dr. Don Shing Kim from California for agreeing to give this webinar, as well as spending his time and share his research with us. I'm thankful to Dr. Don. Just to give a brief of this center, this center undertakes research primarily on financial markets and economy, but it also includes many other related research fields like market structure, regulations, real estate, monetary policy, fiscal issues, including microstructure like commodities, banking, bond market, SME financing, financial inclusion. Of late, we have been working on financial inclusion in a greater detail. We also facilitate a kind of wider scope for research among faculty, as well as with doctoral students or others who are interested working with us. We are also engaging ourselves with stakeholders who influence policy, or as well as those who are influenced by those policies. And we are constantly engaged with the academia, where we try to get some idea about the state of the art at the current moment, and the webinar series is actually towards that. With this brief introduction on the center, I hand it over to Prashant to take it forward. Over to you, Prashant. Thank you.
Thank you, Dr. Vimandas. It's absolutely a pleasure to bring Dr. Dongshin Kim to our webinar series. Dr. Kim and I have been friends for a very long time, and this is one person that I have always looked up to. So as PhD students in Atlanta, while I was struggling with the basics of programming in R, Don was already planning to write a whole new package in R. So that was the level of difference when it comes to our empirical skills. And then Don, as we call him, has been very prolific when it comes to research on REITs, real estate investment trusts. While many markets in the world adopted REITs in late 50s, India was a bit late. We introduced REITs, real estate investment trusts in India just a few years ago. And that makes this research very topical for us and very relevant for us. So while the context for this paper is specific to REITs, I have reasons to believe that many other industries may also be able to use the findings for their investment or policy making purposes. Dr. Kim's research primarily focuses on commercial real estate, mortgages, real estate investment trusts, and housing economics. His research work has appeared in premier real estate journals, including Real Estate Economics, Journal of Real Estate Finance and Economics, and Journal of Real Estate Research. Don is also interested in technology, as I said. He released his model selection algorithm software as an R language package and published a paper in the R journal. Dr. Kim has taught various real estate and finance courses at the master's level. Dr. Kim worked in the industry for over 7 years before his academic career, and he worked as a senior programming engineer with a startup venture software company. Afterwards, he worked in a real estate development company where he managed development projects and real estate investment trusts. Dr. Kim holds a PhD and MS in real estate from Georgia State University, Go Panthers, MS in finance from Seoul National University, and a BA in engineering from Seoul National University as well. Today, he will be presenting his research on predictability and information in REIT implied volatility. Since REITs were introduced in India by SEBI, they have garnered a lot of attention from investors. Several exciting REITs have been launched in recent years, and more are in pipeline. REITs in India were modeled primarily after REITs in the US. Dr. Kim's study is based on US REITs, but we hope that the findings will be universally applicable as much in India. After the presentation, we will have a short Q&A session. If you have questions or feedback related to his research, please message me in the chat box. I will try to post them when appropriate. In the meanwhile, I will grant panelists access to some of the attendees. The panelists may feel free to directly ask questions by unmuting themselves if they feel a need. But just because I make you panelist does not exert any pressure that you have to participate or speak. Dr. Kim, we look forward to your presentation now. The floor is yours.
Okay, thank you. Thank you, Dr. Das, for your kind introduction about me. And so Dr. Das and my friendship goes way back, for decades of history. And when I started my PhD, he was my senior at Georgia State. And actually, he was a really great mentor to me, and he was supporter, and he's really, really smart. So I'm really humbled that he had to introduce me like that. So, okay, so let's start my presentation. So hello, everyone. This is here. I'm in LA. It's early in the morning. It's 6:40 a.m. in the morning, but it's very nice. So, and it is my great pleasure to present my research in the webinar series at Misra Center for Financial Markets and Economy, Indian Institute of Management, Ahmedabad. And I'm an assistant professor of finance and real estate at Pepperdine University. And I prepared my research presentation today. It has a lot of slides, but I hope you all enjoy my presentation today. And from now, I'm going to share my screen. Okay. Then, so I guess you are now watching my screen, the PowerPoint slide. So, and I understand the audience is in here is very various. So we have MBA students and industry expert, and as well as scholars. So I'm going to introduce some basics and then go to my research, and probably I'm going to use some little bit of teaching style presentation today that I use in my classroom. So I found this easier to do the presentation. So, okay. So the topic of my research is predictability and information in REIT implied volatility. And I'm working with Dr. Clemens Konatsky and Dr. Abraham Park and Song-Eun Kwon in this project. We've been working this for years. So as a brief introduction, so volatility is an important measure of financial risk, and there is extensive literature on volatility and implied volatility indexes in general stock market. However, risk estimates for real estate have not been well developed yet. Actually, this is the motivation of our research. And in this research, we firstly introduced a new REIT Implied Volatility Index. We named it as IIR fix, and there's reason for the IIR here. And we used 30-day option prices on IIR ETF. This is a REIT ETF as an underlying asset for risk estimates. And IIR fix is derived from the traditional fix methodology. So just I'm going to introduce everything in later slides. So we throw two research questions in here. So first of all, we create this new IIR VIX to enhance the existing literature and to help the industry experts in investment decisions. So first of all, we check the validity of this measure. So whether this IIR VIX is better risk measure for REIT than any other VIXs or other equity market time series data. So that's our first purpose of this research. And then we compare our VIX with the general stock market VIX. So how real estate sector is different from general stock market in regard to the implied volatility. So that's our second goal. And again, I'm giving you just a very basic introduction about REIT. What is REIT? So REIT is real estate stands for real estate investment trust, and REITs are the firms or vehicles that majorly invest in and operate real estate. They are the company who are investing in real estate and real estate. And we all know that in finance industry, that real estate is a good investment asset class. However, direct investment in real estate requires a chunk of money because of size. And also it requires a lot of special knowledge to purchase it and operate it and manage it. It's a lot of knowledge. So it is not easy for the retail investors to directly invest in the commercial real estate. So instead of directly investing in real estate, investors can use REITs as an indirect investment tool. So REIT enables the investors to make indirect investment in real estate. So investors can buy shares of REIT company, then REIT instead, they purchase physical properties from the market and they manage it and operate it. And then they collect the income and they distribute their incomes as a dividend to the investors. In this way, the investors can make an indirect investment in real estate. And then you may have a question, then why REIT as a question? So, I mean, to make an investment in real estate, you can form a LLC or just general corporation or fund, whatever. You can have different structure. Then why REIT? And this is one of the most benefit of REIT structure. So REIT pays no income tax at the company level as far as they pay out 90% of their income as dividend. So there's no double taxation at the company level as at the investor level. So that's a big benefit for being a REIT. And this is a snapshot in the US REIT market. So as of 2021, the total market cap of REIT was $1.5 trillion. And in 2019, they distributed $111 billion as dividend. And there are around 220-ish REITs, active REITs are in the US market. And out of them, 28 REITs are constituents of S&P 500 index. So REIT has great influence on S&P 500 index right now. And in 2020, they raised a fund from the public market of $106 billion, either from public equity market or public debt market. And altogether, REITs are holding almost $3.5 trillion worth of physical real estate properties. So they are big players in real estate market. REITs are the big players in the US real estate market. And these are some special characteristics of REIT in the US market. And REIT has really, really unique characters than other companies, and even there's a book about REIT. But so here, just in one slide, I'm going to discuss these unique characteristics, which is relevant to our research. So as I mentioned, REITs are required to pay out 90% of their income as dividend. And this means that this 90% dividend means that the REITs investment income mainly comes from dividend. So the REITs are typically long-term investment vehicles that attract income-oriented investors rather than the gross income oriented investors. And also, REITs are known as transparent entity compared to other companies, and there is reason that is related to this 90% income distribution requirement. So because they have to pay out almost all their incomes, 90% of their incomes as dividend, so they are always short of internal funds. They have no cash. So if they want to make additional investment, they have to raise funds from the public markets, either from equity market or debt market. So, and the transparency of the company helps to lower their cost of capital while they are raising the fund. So it is important for the REITs to keep their company transparent to lower their cost of capital. Also, REIT investments are, as we all know, that physical real estate, and real estate investments are highly observable. We can see what they are buying, what they are selling, and what type of properties they are buying, and what they are doing, and how the building is performing. So it's very transparent. Their investment is very, very observable. So for all those reasons, REITs are known as a transparent entity compared to other companies. And this slide is about REIT in India and other countries other than US. And I got this from Dr. Das' paper in 2016, Journal of Real Estate Literature. So in terms of nominal GDP, India is a huge, big company. Like as of 2016, it was world's 7th largest economy GDP. And in terms of population, is 1.2 billion people living in India. And however, in terms of size of real estate market is $350 billion, which is kind of relatively small compared to other countries. So I'm originally from South Korea, and South Korea has this GDP and only 50 million, not only, but just 50 million people living in there. And real estate size is a little bit bigger than in Indian market. And again, that was like 2016, now it's 5 years past. Maybe Indian market, I guess, has been growing more. So I believe that India, considering all the GDP and the population, has great potential in general real estate market, also in the growth in the REIT market as well. So I truly believe that there's great potential in real estate in India. And this is
There's a question from the audience. Nikhil Isaac is asking, do you see REITs and blockchain or crypto coming together soon in emerging economies like India? So this is not very relevant to your research, but what is your opinion? Do you think REITs can come big time in emerging economies? Because, South Korea and the US, they're developed markets.
Yeah, so very interesting and nice question. So I mean, REITs and especially blockchain is like huge hype in these days. Everybody is talking about it. So there's like intrusion of this blockchain in real estate sector in general. So I don't know. So I don't know. But
so if I could jump in on your behalf, Dr. Kim, Nikhil, the blockchain and crypto, they have been in the news in India recently. The regulators have a certain view on it. It has been here for some time, but what the future will be is yet to be seen. REITs are there in India already, as this slide is showing, and newer REITs are being launched in India, and they have been quite successful when it comes to their performance in the stock market so far. So, Dr. Kim, you could please go forward.
Yeah. So, and also, I guess as I mentioned in the first slide, this slide, REITs are basically they attract the income oriented. They need some stable income. The investors on this REITs are who require some stable income. So, and the cryptocurrency and the blockchain is I think it's piloting and some taking adventure type. So maybe REITs will be slow in adapting. That's my expectation. So again, so it's difficult to predict the future, what's going to happen. Okay, next slide. And so this is Indian REIT structures. I got this picture from Indian website, and I don't know whether this website is popular or not, but so picture was beautiful. So I took it from there. So I'm not going to explain everything. It looks just basically what I'm to say is it looks like very complicated, and it is true. And just one thing I want to emphasize in here. So you have REIT entity in here, then you can see this like a external outside REIT manager. So this is usually called as externally managed REIT. And I assume, I guess, Indian REIT structure right now is almost externally managed REIT. And on the other hand, in contrast, in the US, most of the REITs are self-managed. That means REIT has in-house REIT manager in the company. So they are like a self-standing, standing alone companies. And in South Korea, they adapted the REIT in just couple in 2001. And most of the REIT company in South Korea is also externally managed ones. And I heard just a couple of companies are trying to be self-managed REIT right now. And there are pros and cons about being externally managed and self-managed. And Dr. Das paper has a lot of details about it. So you can find more good stuff from there. Actually, I jumped from this slide, right, to the next one. So US adopted the REIT in 1960, and India adopted REIT in 2014, and South Korea 2001, and Japan in 2000. And there are these countries actually currently having US style REIT approach. And you can find more details about Indian REIT from Dr. Das paper in 2016, Strategic Development of REIT in India, Journal of Real Estate Researchers. This is great paper from great professor, great researcher. Okay, so that was like brief introduction about REIT, and now so we are talking about implied volatility in REIT. So it's about just a little bit about implied volatility. So what is implied volatility or IB? So again, volatility is a measure of risk. So, but it's not observable, but we can estimate or forecast. So you can either backward looking or forward looking to estimate or forecast the future. So the backward looking and time series forecast include like realized volatility. First, realized volatility is simply just you take the standard deviation of past returns, what happened in the past month. So, and just use it for the future prediction. Or if you can be a little bit more complicated in time series modeling, you can use different types of gauge models. So this also is the historical standard deviation of stock returns, but again, it is a little bit more sophisticated time series modeling. So it visualizes as oscillations around the mean. And IV, this implied volatility, is different. This is forward looking. So we are looking forward risk measure, and IV is implied volatility is derived from option prices by solving unknown volatility via Black-Scholes equation or any other option price models. So this is kind of reverse engineering to find out the volatility. So essentially, if everything is complicated, you can say this as option traders forecast of future volatility. Is this the wisdom of crowd? Their options are their opinions. I think this is the future volatility. That's the implied volatility. So getting from the option traders. And the VIX is the most popular market measure of future risk. And this is a 30-day estimate, so 30-day ahead estimate of future volatility, so which is implied from S&P 500 index options from the general stock market. And because VIX is about the future risk and volatility is also known as investor fear index. So that's what we are talking about here today. And so Poon and Granger, in 2003, they did extensive literature review, and they reviewed 93 published papers on the performance on different types of volatility models. And in terms of forecasting power, they linked the forecasting power of implied volatility as a top. And the second was historical volatility, like moving average over the past. And third was gauge models. And VIX are not the only VIX available implied volatility, and there are various VIX products in CBOE. So again, just VIX on S&P 500 is 100 index is most popular one, and there are VIX on Russia 2000 and Euro and crude oil, Apple company and Amazon company VIX, and also there's alternative VIX index from CME Group Zero indexes or Eurex VSTOXX or VDEX, many more. So there are many different types of volatility index. And now we are combining together real estate and VIX. So VIX in real estate sector. So in September 2016, S&P 500 real estate sector index was launched and made the real estate as the 11th sector in the overall stock market. However, there is no relevant VIX for real estate sector yet. And only trial to make VIX in real estate sector was by me, Benson, and Fab in 2018. And they introduced a real estate VIX. They named it as RE-VIX, and using a state preference approach. So it is a lot of econometrics there, so I'm not going to explain that, but it is a state preference approach. And however, in their research, they didn't have enough option trading liquidity in their benchmark, which was their benchmark was S&P 5 US REIT index. And so what they did was they indirectly built this RE-VIX using S&P 500 index, which is general stock market. Also, they use a regular VIX, and they mix it with the returns on S&P US REIT index. So just in a word, this is not a purely option trading based. This is not the option trading based VIX index. This is a hybrid volatility index. So in our research, we firstly create purely option trading based with real estate VIX, IIR VIX, and also we show the performance of our IR VIX and some unique characteristics of our IIR VIX. So in terms of data, so we use IIR. This is a ticker name. That's why we named it as IIR VIX, ETF options data. So this IIR ETF is options on iShares US Real Estate Exchange Trade Fund ETF. And again, the ticker is IIR. And IIR uses Dow Jones US Real Estate Index as their benchmark. And as of September 2022, that is almost 30% of its constituents are REIT stocks. So it has just small number of real estate companies, non-REIT companies, but 30% of stocks are REIT. So we can safely call it as REIT index or just real estate index interchangeably. So it's fine. And our data period is from 2005. This is the first day the data is available for those option trading data, 2005, January to November 2020. And we also considered all other possible alternatives other than IIR. And first one was S&P US REIT Index, which already used by MBF in 2018. But again, this one has no equity option market. So this is out of consideration. And another one is a VNQ, which is Vanguard Real Estate Index Fund, but it does not have nearly enough option liquidity or trading volume as IIR. So we chose IIR as our underlying asset for our research. And this is actually comparison of IIR in the blue line and the S&P US index and in the blue line, and they are very, very similar, as you can see. So there's almost no issue in using IIR trading data. So now it's a little bit of math. Starting, we are going into some kind of little bit of like actual research, academic type of research. So we defined.
What was the red graph there in the previous slide?
Red one?
In the previous slide, yeah.
Yeah, so these ones are just ETF, just index of two. So in this IIR, this is our underlying, and this is another like maybe just potential candidate for our research, which is S&P US REIT. And actually we chose this one over this one because this one doesn't have option market. So, but we wanted to show that they move very, very close to each other.
Okay.
Okay, thank you. Thank you. So just we start defining the basics. So return is this. So we have daily IIR data. So return is this is daily return. So log of today's index and the yesterday's return. So this is basically just daily return of the index. And then we define this realized volatility. So of the future realized volatility. So this is basically standard deviation of 22 days ahead return series. And actually in this slide, I use sometimes 30 days or 22 days, but they are the same. So either 30 days calendar days or 22 trading days on average. So they are the same thing. We are talking about just 1 month ahead. So 1 month ahead standard deviation. So we named it as IIR, R for realized volatility at time T, 22 days ahead. So this is measure. So, and this 252 is number of days, trading days in a year. So this is an annualized volatility or standard deviation of return over 30 days ahead period from time t+1 to t+22. So again, 30 calendar days or 22 trading days are equal thing, same thing. So basic two metrics, return and the volatility, standard deviation, future standard deviation. So those two are the basic math we need to understand. And then with that, we start building our IIR implied volatility index. And these are the steps we are taking in here. And we build this 30-day ahead volatility index. So we purely follow the original VIX algorithm introduced by Whaley in 1993. And this algorithm inverts a Black-Scholes multi-model from 8 nearby at-the-money options on the underlying REIT ETF. So these are the steps. Again, this algorithm is well introduced in Whaley's paper. So, and these are the introduction. And I'm going to move forward to the next slide. And Dr. Das has some question.
Yeah, Alok, do you want to unmute yourself?
Yeah, I have a small clarification. Like in realized vol, I don't see any adjustment for the overnight vol as such. So is there any reason as such for the same?
Alok, could you introduce yourself, please?
Yeah. Hi. So I'm Alok. I'm from IIM Lucknow. I'm with finance and accounting area at IIM Lucknow. My question is, in the realized vol, we are not scaling it for the overnight volatility. So is there any reason as such for the same?
So, honestly, I have to check with my co-author. So Dr. Clemens Konradsky, he is the expert in this derivatives and options market, and he was the one who came up with this idea, and he showed me the algorithm how to do it, and I implement in R. And so all the details for those ones. So and I think he knows better than me. So in general, I guess even if we correct on those overnight volatility, the result won't be that different than from our current findings. So we did.
Okay. Thanks. Yeah. I got it. I think you're working on the daily data itself. Yeah. Thank you. Thanks.
Okay. Thank you.
Yeah.
So those are the steps for the to build implied volatility. And finally, we have this outcome. So this blue line is IIR R-vol. This is a realized volatility. So this is actual volatility, and this red line is our IIR VIX, our estimate. So you can see the IIR VIX is very closely tracking the realized volatility. There you can see some lag there, but overall it looks good. And then,
so Clemens Kowalski is writing that we only had daily end of day closing prices, hence no scaling for overnight. Okay.
Thank you, Clemens. Yeah. He is a really super genius professor that I'm working. I'm really glad to having a lot of pleasure working in him. So yeah. Okay, I'm also glad that he's here to help me, to support me. So I have really great teams. Yeah. So anyway, so let's move on and methodology. So now we built our IIR VIX, and it's time to check the validity of our VIX, whether this is good enough. So I'm going to quickly introduce the methodology, and the result will be following at the end of the slide. So we compare our IIR VIX with other 30-day ahead volatility forecast, which includes compare ours with other two implied volatilities, which is VIX, which is for the regular stock market VIX, and also ST VIX. This is state preference VIX developed by MBF in 2018. So we replicate the algorithm, and we built this ST VIX as well. And also two time series forecast, volatility forecast. First one is historical moving simple average volatility. So basically the past month's volatility. And also we use the GARCH 1.1 model to forecast the future 20 days ahead volatility. So we compare ours with VIX and ST VIX and moving average and GARCH. And we also split our data period into volatile period and non-volatile period. And the volatile period includes global financial crisis in 2007 to 2009, and the current COVID period from 2020 February to the end of the data period. And of course, non-volatile period is excluding all those volatile periods. And first one, we compare the predictive power. So we mostly follow the Julian's methodology, Journal of Finance in 1995. So first we report the mean, simple mean, absolute error. So smaller is always better in terms of error. So we compare this, this is realized volatility, this is actual volatility, future volatility, minus F4, which is forecast volatility, which include our IIR VIX and VIX and SDVIX and moving average and gauge. So we compare the mean absolute error of our estimate with others. And so among those, which one has a minimum mean absolute error? So smaller, of course, is better. And then we run some regression. So we regress realized volatility against forecast volatility. So the reasoning behind this regression is that if this forecast volatility, which includes all those forecast volatility, if this is good enough estimate for the future realized volatility, which is our vol, then the beta P should be equal to 1 because they are should be the same one. And the alpha P should be equal to 0. So we run this regression, right? So if this F4 again is good enough for our vol, then it should be 1 and alpha P should be 0. So that's the first one we are going to test. And then, yeah, Dr. Das.
Sumit Saurav, a colleague here, is a PhD candidate. He has a suggestion. And he says, he's asking first, how liquid are OTM options? And if they are liquid, then one could also estimate the skew of the implied volatility curve and use the skew as a measure of sentiment of real estate market.
Okay. Yeah, good suggestion. So
we could take it up later on as well, if you can.
Yeah, so we'll look at it. That's very nice suggestion. It's very smart, smart idea.
I have one small clarification. May I please?
Yeah.
This is the in the equation you are saying forecast volatility for 22 days. I just wanted to have some clarity. How are we forecasting for 22 days ahead? Because you are using daily data. So how are you forecasting 22 days ahead future vol?
So this one, right? So for IIR VIX, again, this one is option. So when they trade the option traders are buying the future, right? So and all the volatility is priced on the option pricing. So that's why this is implied volatility of a future. So we look at the 30-day ahead, like which options mature in 30 days. So those are all like ID, the implied volatility indexes. And for moving average, this one is a time series. So again, this is basically we use the past month volatility standard deviation will be the same as next day volatility. That's a simple estimation. And gauge is, so using gauge 1.1, we fit the model gauge 1.1, then from the gauge, all the estimates, we predict the 22 days ahead volatility.
So from the gauge, are you forecasting for 22 days ahead or is 1 day ahead?
Yes. Yeah, 22 days ahead using gauge.
Yeah, and this is slightly because I'm not sure if you will directly have this answer, but what is the frequency of expiry dates on these options? So is it is it once a month? Is it weekly? Because that would also so Alok's question is real. I guess it's related to that for 22 days advance.
Yeah, sir. And one more observation, because in gauge models, if you forecast more than one period ahead, so generally it converges to unconditional vol. So
right.
So that's again an issue that I'm not sure about what is being done.
So you're saying that the conditional volatility tends to converge towards unconditional volatility in
Yeah,
cash. But
yeah.
I guess, Professor Dikshit, this is also about how large your data set is. So I guess you're right. If it's a daily frequency
Yeah, yeah.
model, then it will tend to. So in other words, volatility 22 days ahead will not be too far off from volatility 21 days ahead, but that difference would be much larger in the earlier.
Yeah, that's true. So actually, in cards, there's like a lot of things I want to discuss, but it has a lot of technicality behind it. So we are using like a moving window, like data period, because every time you collect more data for 2 estimate cards. So every day, so you have like from the beginning, so every day you have 1 more data each day. So we are doing like moving average, moving window, like card estimation. And then also we predict using that card, we predict 22 days ahead. And yes, that's
maybe if we are doing it ex post, so say by the end of 22 days, I can look back and measure the wall which was measured by a Garch model. That possibly.
Okay, so let's continue this discussion.
Yeah, please.
After the presentation is over. But I mean, interesting observations, Professor Dikshit.
Thank you, sir.
Okay. Yeah, thank you. So, and then in the next regression, we run similar to the previous one, but we split this F4 forecast volatility into implied volatility type, which includes our IR VIX and ST VIX, and time series forecast, which is moving average of standard deviation in the past and the gauge of the past time series model. And the reasoning behind it is we are mostly talking about implied volatility is the best measure for the future realized volatility. And if F4 forecast implied volatility forecast is good enough, implied volatility, then the addition of this time series information should not add any additional information onto it. So again, if this is good enough, then we don't need it. So we are going to check whether the coefficient of theta will be significant or insignificant. So this is a methodology to check the validity of this our measure. And another question from Dr. Das.
Clemens, would you like to unmute yourself and speak, or do you like me to read your comments?
I can go ahead and talk. That's fine. I like the idea of using the skew, but that was slightly out of our time frame because we wanted to really investigate the straightforward measure of volatility. To the question in terms of liquidity, out of the money options are typically not as liquid. That's correct, but we used only the relatively close to at the money prices. So we used really from the 2 calendar months that we looked at, the nearby and the second nearby, we used always 2 pairs of the strike prices that are closest to at the money as our model.
Okay.
The current VIX method is very different. It's actually no longer a Black-Scholes model, and they look at very much out of the money options that are relatively far away from the current price. Just for clarification.
Thanks, Clemens.
Thank you.
Go ahead, Dr. Kim.
Yep. Okay, so my son just woke up and calling me out of the door.
Good morning in Los Angeles.
Yeah. So and then so we test another like information in this forecast volatility. So again, this F4 future realized volatility and the forecast volatility is talking about 22 days ahead, like period. And however, we also test whether this one has the information for the next day's information, volatility. So again, we are following this Jordan's general finance methodology here. And the definition of next day volatility is square root of return, which is basically absolute size of the return. So how big the size in the next day. So very similar reasoning as before. So how this F4 is performing in terms of predicting next day's volatility and whether this time series data has additional information on top of this implied volatilities. That's the second test we are going to do. And then we also, VIX is known as investor fear gauge, and we also test the fear reflection on our forecast volatilities. So we regress the changes in F4 forecast volatility against return and RT is return and RT negative. And RT negative is equal to RT return itself. And if the when the return is negative, and if the return is positive, then we make everything into zero. That means we only conserve the negative value of RT. The reason why we are doing it is to capture the asymmetrical investor fear. So if the return goes down, then they will be more fearful. So we are capturing just asymmetrical fear reaction against the return. So we are following the Whaley's 2009 methodology in here. And so we test with investor fear is mostly reflected on which volatility forecast among ours, IOL VIX and VIX, STVIX, MA, and GARS. And for regressions 1 and 3, we report the new US standard errors to address the heteroscedasticity and autocorrelation issue in residuals. And so finally, so I don't know whether I can finish this slide but so we, if we don't have time, I'm going to skip the result for this one, but we also compare the REIT, real estate sector, REIT and IR VIX, and compare this to the general stock market, S&P 500 and VIX. So we discussed in REIT characteristics that REITs are transparent entities. So we expect that the REIT real estate sector will have better predictive power compared to the general stock market. And also REIT investors are long-term investors, so they are maybe not that much interested in hedging against the short-term volatility. So maybe we expect that they will be less sensitive to the volatility. So IR VIX may underpredict the actual real volatility, and also investor fear will be less reflected on IR VIX than the regular VIX market. So let's see how it goes. So, and finally, now it's time to look at the data result. So this is our data. So a bunch of data we use in this analysis. So this one, IIR R4, this is a realized actual volatility, and on average, standard deviation was 22.3%. And the next one is IIR VIX, which is our implied volatility, and they are very, very close to each other in terms of just simple mean. And VIX is a little bit small, and STVIX like this. And interest means time series models in terms of just mean is very close to actual realized volatility. So this is just a brief snapshot of those measures, but let's look at the more detailed analysis about the validity of our measure, performance of our measure. So first, we report the mean absolute error, so how far our measure is from the actual value. And the first one is IIR VIX hours, and so full period and non-volatile period and volatile period. So or in any periods, IIR VIX has the smallest, so 0.601 and mean absolute error. So ours is outperforming or any other forecast compared to any other things. And especially during the volatile period, global financial crisis and current COVID period. And the mean absolute error for IIR VIX is 0.16 compared to other one like 0.24, 0.222, very high. So ours is really especially outstandingly performing during the volatile period. And that is the period actually we need this index most. So ours is performing best when we need it most. Yeah.
Sorry to interrupt. This is very interesting that time periods when we need them the most are the time periods with highest MAI, right? So when there's high volatility, no matter which model it is, the absolute error is high, right?
Yeah. So it's difficult to predict, of course, right? So it's normal period, and you check the simple time series model, that's fine. But during like COVID and who knows, right? So it's very difficult for who is trained traders, right? So overall it's high, but still. Among those or like different options, IIR VIX implied volatility has the best predictive power. That's the point in here. And then we do the regression. So I kindly put this regression model in here. So what you are expecting from here is beta P is equal to 1 and alpha is 0, because we are expecting F4, the forecast is good enough for the realized volatility. And this is coefficient result. Okay, let's just first look at the regression, R square, just predictive power. So we have IIR VIX and VIX and STVIX and moving average and GARDs, two time series models in here. And R square is higher, really way higher in IIR VIX than the regular stock market VIX. And many previous real estate researchers, they use a VIX to use in real estate because they didn't have any real estate VIX. But their forecast power is very low in here, and STVIX is even lower, and moving average and GARD. So in terms of predictive power, our IR VIX is good, and yeah.
So just another academic question. So if we plot volatility, no matter which measure we are using, these are very spiky curves, and I mean, visually they don't look stationary. Now, I understand that this problem has perhaps a very difficult solution, but if we are modeling the level of volatility, is the high R squared perhaps attributable to the presence of unit root by any chance?
The autocorrelations. So yeah, it has high autocorrelations, but unit root test, I think we did it. So there's no unit root.
Unit root. Okay.
Yeah. And also, as I explained at the beginning, so all the standard deviations are in here. US standard errors, which address all the autocorrelations, heteroscedasticity in the standard errors. So this is
Sumit is also asking if we should check, R squared's significance. I guess you could also post the F statistic here.
Yeah, sure. Yeah, no problem. So I follow the just regular standard in real estate literature, but yeah, definitely you can do it. And
Professor Kowalski is commenting that high autocorrelations are there, but changes in VIX are not stationary. So this is just a comment from your co-author. Please go ahead.
Okay, good. Okay, so and then there's about R square predictive power, and also we want to see whether this beta is equal to 1 and alpha is 0. So let's first look at the IIR VIX, and the alpha, this is intercept is 0, so not significant, and beta is 1.146, and this one is actually testing whether it's 0, so of course significant. And here is the statistics for testing beta p equals 1 probability value and 0.2 20%. So we cannot reject this null hypothesis, means this is equal to 1. So IR VIX has very nice properties, like so alpha is 0 and beta is equal to 1 statistically. So has very nice property and has high predictive power. And compared to IR VIX, and VIX is low R square, and the alpha p is not 0, and the alpha is not 0, and the beta is not equal to 1 either. Like that, there's STVX and others I'm going to skip, or others. And again, IR VIX has very nice property, and also has a high predictive power. And in the next set, in column 2 and 3, we add additional time series information on top of implied volatility. So as a base, we have included everything like IR VIX and STVX as a base measure. Then we add time series information, additional information. So in the first set in column 2, we include moving average. So if you look at the IIR VIX, and let's look at the R square first. And R square without time series information was 0.72, and with time series information 0.721. So you can see almost no change in R square. That means time series is not adding any additional information beyond IIR VIX. And also coefficient is not significant. So again, time series is not adding any information at all to the IIR VIX. On the other hand, if you look at
I have a small clarification here.
Yeah.
Are we controlling for the potential multicollinearity problem here? Because these two measures of vol, they would be correlated.
So actually, no. So just we included those two, and possibly they are correlated.
What is the sample size here, Dr. Kim?
It's almost like 3 3,000, more than 3,000. I have to double check. Okay, so I have sample size.
I mean, this
The
is a
sample
valid,
size, yeah, sample size is big enough actually. So
so the concern is
yeah,
valid.
yeah, 4,000. Yeah, 4,000 sample size is, yeah. So it's good enough size.
I remember
Multiple.
you citing a paper a long time ago which said that with long enough sample sizes, the issue of multicollinearity could be addressed. But as
Yeah.
Professor Dixit is pointing out, this is something worth mentioning in the empirical.
Good point. Thank you for the comment. And then if you look at other like fixed, and the time series information is like now significant. And if you look at the coefficient of R square, is from 0.63 and 0.67, like there's huge improvement in R square as well. That means that for others, time series is adding additional information. So what it means is IIR VIX, our VIX already have rich information. So time series, we don't need the time series data. However, for other VIXs, they are carrying imperfect information. That's why this addition of moving average time series information is improving the regression. And we do the same thing now, this time using gauge information, time series information, and result are same. So not significant and R square is improving significantly, but not for other VIXs. And then let's move on. So this was for the full period, and then we look at the non-volatile period, and results are similar. So I'm going to skip, and volatile periods, the same result for the volatile period. And in conclusion, for this subsection, so overall IR VIX has the best predictive power and information, and time series does not add additional information behind IIR VIX, but does have information beyond other VIXs. So IR VIX has a rich information and good enough by itself. And next step of test was next day volatility. So we ran this regression. So whether this forecast volatility has a predictive power for the next day volatility. And let's look at, this is IIR VIX hours, and look at the R square. So again, R square is highest for IIR VIX compared to other forecast measures, 0.441, like 0.41. Gauge is kind of performing well relative to other method. And in this case, we are looking at full period, and now I just feel a very similar reasoning as before. So we are adding now time series information on top of it. So now everything is significant. So actually, the time series is adding some additional information for the next day's volatility in all the cases. However, if you look at the R square improvement, so again, IR VIX has no improvement in R square, and however has improvement in from VIX and the other state VIX 0.35 to 0.44. So it is improving R square. So again, relatively, our IR VIX has more rich and close to perfect information for the next stage volatility. And again, this is for the full period. However, if we separate this period into volatile, non-volatile period, and now the pattern is very, very similar to our first predictive power. So again, R square is highest in hours, of course. And then in the non-volatile period, time series is not adding any information, does not add any information. And also R square has no improvement error. And on the other hand, for others, there's improvement in R square and time series information is significant. So again, this confirms our finding that the IIR VIX, our VIX has a rich information compared to other VIX estimates. And for the non-volatile period, similar pattern. So high R square and time series does not have any additional information onto IIR VIX. On the other hand, VIX and STVIX, they getting help from the time series model data. So sub-conclusion for this section is about next day volatility. Very, very similar conclusion as before. So IIR VIX best predicts the next day volatility, and time series information does not have any information beyond IIR VIX, but does have beyond other VIXs. And so in conclusion, IIR has the rich information and good enough by itself so far. And then, so this is final regression, not final, just one before the final test, regression test. So investor fear So we run this regression investor fear change in the forecast volatility against a return and negative return. So this is asymmetrical, like to capture the asymmetrical reaction about fear. And just let's try to interpret the first one using ours, IRR fixed, delta IRR fixed, and intercept is there. So our coefficient on return is negative. This means if the return is negative force, then the fear, investor fear goes up because negative return and fear goes up. And R negative is again, the only captures conserve the negative side of the return. So this, which means if there's a negative return, then there will be even higher increase in investor fear. So this is so this tells that the fear gauge asymmetrically goes up when there's return is negative. So everything comes out as previous literatures, and also is like a very intuitive as you expected. And if you look at the R square, so R square is highest in IRR VIX than any other measures. So again, investor fear is most reflected in our IRR VIX in real estate sector. And just interesting thing is in here for this MA and GARCH are the time series models. And if you look at the coefficient on return is positive. This means if the return is negative, then investor fear also goes down, which is really, really counterintuitive. And also is against the previous literature findings in previous literature. So even if their R square, maybe GARCH R square is kind of relatively high, so it's very, there's a question mark whether we can rely on these time series models in terms of investor fear. And so that was for the full period. And then we look at the non-volatile period and same thing. So results are very similar to previous result, and R square is highest in our IRR VIX. And one interesting is that this GARCH has high R square. Again, however, is very, very questionable why this one has positive, not negative sign there. But anyways, one of the reasonings, the outcome for this one is, so this is non-volatile period. So everyone can kind of predict what's going to happen during the normal period. So there's no surprise at all. So in that case, time series information, maybe is good enough to predict just using the time series technology, just good enough to predict the future during the non-volatile period. And then, so this is the investor fear during the volatile period. And again, so like this period, like during the COVID, and this our IR VIX has the most information about the investor fear as well. So not much difference in the full period. So that was the outcome. So investor fear is most reflected in our IR VIX. So luckily we have time to cover everything I wanted to cover today. So now we compare the characteristics of general stock market. So S&P 500 as a general stock market and against the real estate market. So this is for the general stock market, and this is the real estate market. So this table is summary of the previous table. So I already reported it just for the convenience. I just summarized result in here. So again, this is below is the real estate sector characteristics. The top is the general stock market characteristics. And if you first look at so this is a predictability about this regression, R4 and F4, how they predict well. And if you look at the R square first, and R square in S&P general stock market is 0.5, and versus in real estate market is 0.72, which is a lot higher than general stock market. So this is related to maybe the transparency of the REIT industry in general that we discussed at the beginning. So REITs are transparent, so maybe it's easier for the option traders to predict the future volatility. And that is the first finding from this comparison. And then next one we want to look at is beta coefficient on VIX in general stock market and the beta coefficient on IRR VIX. And you can see this one, this beta is less than 1, and this coefficient is greater than 1. What it means is in general stock market, the VIX volatility is over predicting the realized volatility. That's why we have less than 1 0 less than 1 coefficient to downward correct the over prediction. And on the other hand, this is opposite in real estate. So in real estate, the coefficient is 1, greater than 1, which means, so in real estate sector, the IIR VIX is under predicting the actual realized volatility. That's why we are doing this upward correction using with this coefficient greater than 1 coefficient. So this means, this maybe implies that the rich investors are less sensitive to the equity market short-term volatility. That's why they are under predicting the volatility. So that is stemming from the nature that the investors of rich stocks, they are long-term, typically long-term investors. So long-term investment and short-term volatility, they don't care less than the general stock market investors. So those are the findings from this comparison in terms of predictability. And then we compare the next one, next day volatility compare. So again, the upper one is general stock market and the bottom one is real estate sector. So about how do they predict the next day volatility? So again, is R square is predictive power is higher on real estate sector than general stock market. So again, this is a prediction for the next day volatility. So higher R square means which are transparent, predict the same reasoning. So this is another support that the which are transparent, so they are easier to predict than the general stock market. And lastly, finally, our last final result. So same thing here at the top, we have general stock market and the real estate sector, and we are comparing the investor fear. And just coefficients are very intuitive, as came out as we expected in general stock market and real estate sector. And if you look at R square, now R square is higher in general stock market than the real estate market. And this again means investors maybe don't care, but care less about the volatility or the short-term volatility because they are long-term investors. So this is another support for the long-term investors. So REIT investors are long-term investors. That's why they are less sensitive to the short-term volatility of the stock market. And so sub conclusion about this comparison of S&P 500 and the real estate market. So compared to general other regular stock market S&P 500, real estate sector is more transparent to predict in regard to VIX, and also they are less sensitive to the short-term volatility because they are the long-term investors. So as a conclusion altogether, so in this research, we created option trading based REIT implied volatility IIR VIX, and we showed all the results that it outperforms in prediction of future volatility, which includes like regular market, general market VIX or state preference approach VIX. So it outperforms both of the implied volatility indexes, and also it outperforms all the time series forecasts. Simple moving average or gauge, it outperforms that as well. And it also contains more information regarding the next day volatility, also about the investor fear. So our IIR VIX has a better predictability power and more information and has very nice properties compared to other volatility measures. And then we compared our real estate sector with the general stock market. So IIR VIX predicts the 22 days ahead volatility and next day volatility better than VIX. So it has better predictive power for the future. So which are transparent. That's because we give the reason for that is because which are relatively transparent to any other sector. And however, with the somewhat under predicts the volatility while VIX over predicts. The general stock market over predicts the realized volatility. And also investor fear is less reflected in IIR VIX than the regular stock market VIX. And all these findings support that REIT option traders are less sensitive to short-term volatility for hedging purpose because REIT investors are in general long-term investors. So this concludes my PowerPoint slide and presentation, and thank you. And thank you for all your questions, very nice questions and comments.
Well, not yet, Dr. Kim. We could
Oh,
do a
okay.
small session of Q&A. Thank you for your time.
Okay.
Before we move ahead, Professor Kowalski has added a comment. He says a small correction from his earlier comment. Says that VIX level typically has high autocorrelations, but the changes of VIX show autocorrelations drop off quite fast. Okay, so this is in response to perhaps the econometric concern of the OLS models. And he says he recalls doing stationarity tests before in previous work and changes were stationary. Yeah, I remember in some of the instances, the volatility first differences were stationary, but I guess if there is economic theory, not sure if this is really as big a concern from the reviewer standpoint. Dr. Abhiman Das may have a different view on it. Do we have more questions or comments? Sumit, would you like to unmute yourself? Sumit is our PhD student here.
Yeah. Hello, everyone.
Hello.
Yeah. So I'm Sumit. I am a PhD student in finance and accounting area at IMA. So I have a very, it's a question which is not related to the paper. So generally for index options and single stock options, this IV is generally greater than realized vol. This is a sort of, different papers have established in it across markets. So do we find same kind of relation in the real estate sector?
So probably this chart shows to address your question, and this chart and our comparison in not here. Here. So it is well known that in general stock market, I guess something like you're talking about in just general stock market, VIX usually over predictable volatility. However, it's opposite in real estate sector. Like if you, let's see, where is it? Here. So you can see like in general, like during the volatile period, it under predicts. And actually during the non-volatile period, so this was that actually I didn't mention during the presentation because of time, but during the non-volatile period, you can see still that our VIX is over predicting the realized volatility, and here is opposite. During the volatile period, it's under predicting, and the result indeed here is where is it? Here. So see, so war in just if you look at the big picture of entire period, still the general stock market is over predicting, so less than 1, and in general in real estate market is under predicting, so it's the coefficient is greater than 1. But if you look at the non-volatile period, and both of the series actually over predicting the real volatility. However, the size of prediction is bigger in general stock market. So it has 0.7 and 0.8. So relatively, general stock market always over predict the real volatility compared to the real estate sector.
Yeah, and if with my limited knowledge of this area, I could add to this, Sumit, US markets in general have been struggling with the availability of derivatives in the real estate segment. Europe is perhaps a step ahead. So it's just heartening to see that there is an option available, or at least on some ETFs. So I'm not sure if individual REITs would have derivatives trading on them, at least not on exchanges.
Yeah, so actually we discussed about that in our paper manuscript using, so one of the real estate research paper, I think it's JD paper, and one of the authors was Dr. Sarmas, I guess, and they use the individual option trading data to do like some research on implied volatility. And actually Clemens has a better idea than me, but for the individual stocks, they don't have enough liquidity for the option data. So if you use individual option trading data for individual stock, then it fluctuates and it kind of biases the result a lot. So that's one of our counter argument about using individual option trading data against this index data because of the liquidity.
So yes, I have a few more additions to this, if you don't mind.
Please.
Yeah, please go ahead.
So first of all, there are individual REIT options that are available, but they are not nearly as liquid. And what's even more important is when we have individual stocks or individual REITs, they have quarterly earnings reports that really skew the implied volatility much more towards the earnings announcements. So we have additional concerns because of these 4 quarterly earning reports that come into the data that just raise the implied volatility to a level that is just not consistent with perhaps a more broader index like a REIT index or REIT index ETF. I also wanted to comment about the earlier question about over predicting the actual volatility. There's a relatively easy intuition behind this. If you think of options as an insurance product, most of us have an insurance for our needs, our personal needs, car insurance, home insurance, health insurance. And we all know intuitively that we are basically overpaying for the insurance, but we still do it because we want to sleep well at night. And there's a similar analogy when you look at portfolios. People invest in the markets, their natural position is typically a long position in the market. And they protect that with typically index options or individual options. And so the need to protect raises the prices of these options, and hence the implied volatility derived from that.
Mm-hmm. Okay, so thank you, Professor Kowalski. We have less than 10 minutes left, and we have a bunch of questions. So Alok, would you briefly ask a question?
Yeah, very quick clarification. The MA model of volatility, is it kind of an arch model, or just one clarification in your question?
Basically it's a moving average, means just the past month, just 1 month before the standard deviation. It's very just naive estimation of the future. So I have no idea. So I'm going to use this month volatility as next month's volatility. So moving average. Yeah.
Okay, thanks.
Okay, Shiv, we will take your question offline, okay? I guess I'm not missing on any questions. So then I will take the liberty to share my comments and suggestions. First, like proponents of the Garch model could argue that Garch is not necessarily as retrospective as perhaps you position in this paper, because eventually it is a forecast of the future. And as you rightly pointed out in the beginning, that past is the best predictor of future anyways. And one advantage with Garch is that, especially in X-Garch models, you could include exogenous variables in prediction as well. I was wondering if some future study related to yours could also focus on some of those exogenous variables that come from the real estate industry.
Okay. That's a good suggestion. And actually there are like bunch of different Garch models, as you know, like G-Garch, F-Garch, whatsoever, and also all those like good Garch models.
Even in the classical Garch, for example, you could include exogenous variables as the independent. Secondly, I think in early 2000s, there were NCREIF-based derivatives that had been launched in the US. I'm not sure if they're still there, but that may also be an area worth exploring. If you could potentially, I think those are mostly OTC kind of derivatives, but maybe NCREIF might have some data on NCREIF index-based derivatives. I think there were a few.
Yeah. So as far as we did research, and VNQ Vanguard and this SIIR was the most popular, like traded options. And we also consider like making indexes from both of the option trading data and do this kind of weighted average about index. And we've been thinking, but for now, just we want to focus on like publishing newspaper with using one data. I mean, methodology is there and everything is there. So like basically just plugging in this additional data is the matter. So yeah, good suggestion. Thank you.
So I see we have addressed most of the questions here. So I will request Professor Abhiman Das to close the session for tonight. You are on mute, Professor Das.
Thank you, Don, for sharing your research with us. It's quite, I think, quite interesting, quite fascinating. Just one point, what I had in mind, if you can incorporate and tell as a common investor, how these results could be used to make money out of REITs dividends.
Yeah, I think that's the most important, right, part. So
yes.
why doing this, right? So how can you make money out of this thing? Yeah, really, yeah, good point.
So, and you know, this is more interesting for us at this particular point because REITs has been introduced in India and it is doing quite well. There are not just one, there are two are already in operation. Third one is, I think it's coming up. And there are pockets of markets where they are at present, I think, working quite well. And there is a concern that that may lead to, I think, driving out the small real estate firms, but that we'll see at the later stage. But in terms of your inputs and sharing the ideas, particularly the volatility analysis, what you have shown is quite fascinating. Thank you very much. Thank you very much. And we look forward to you connecting on future collaboration from our center, as well as if you have, you know, potential ideas to share with us where we can jointly collaborate, that also would be useful. Thank you, Don.
Thank you, Dr. Das.
Thank you everyone for attending. Our next webinar is scheduled for 1st September, if I'm not wrong. And I hope all of you will join our next webinar.